Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to a forward exchange contract for speculation purposes only. So we're going to have another forward exchange contract focusing just in on the forward exchange contract. It will be a little different than the forward exchange contracts we would have had in the past, because it's going to be kind of like the opposite. We're going to have the dollars receivable from the exchange broker as opposed to having the foreign currency receivable from the exchange broker. And then we're going to have the foreign currency payable to the exchange broker as opposed to having the dollars payable to the exchange broker. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. If you would like to follow along in OneNote and you have access to it, you don't need to have access to it, but if you have access and want to follow along, we're on the 1140 C4 item and we're in the problem presentations tab. We're going to go over all the information for the practice problem, then we'll pull pieces relevant to the particular calculation we will be on as we work through the practice problem. We're going to be dealing with a forward exchange contract. We have a timeline. The timeline will be on 10/1/X1, we entered into a 180-day speculative forward contract. So it's going to be a 180-day contract. We're going to focus specifically on the forward exchange contract and not have it related to anything else. So we're going to focus in on it. It will be different than what we've seen in the past because, once again, we're going to be focusing in on the dollars receivable from the exchange broker as opposed to the foreign currency receivable from the exchange broker, and we will be focusing in on the foreign currency payable to the exchange broker as opposed to the dollars payable to the exchange broker. In other words, we have kind of like the opposite of the forward exchange contract that we have seen before, a speculation going kind of the opposite way as what we've been using the forward exchange contracts in the past for. So we have on 12/31/X1, we have the balance sheet date. We're going to have to make the adjustments to the fair value as of that point in time, kind of like the adjusting journal entries. And then on 4/1/X2, deliver francs and receive dollars to settle the forward contract. So in other words, this is where we kind of know that this is going to be the opposite of what we normally have. We're going to be dealing with francs here as the foreign currency, and then we have our financial statements in dollars. We're going to be delivering the francs at the end of the day and receiving dollars. So the dollars are what we're going to get, and we're going to be expending the francs at the end of the contract. So we're going to have then the spot rates and the forward exchange rates that will be relevant to our problem, including 10/1, 12/31, and 4/1 of the following year. So we're first going to put the forward contract on the books. So first we'll put it on the books. Same kind of thing. We're going to have a receivable and a payable. However, this is going to be slightly different, slightly reversed. And I've included some of the other accounts that we've used in prior practice problems, even though we won't be using them here, just so you can kind of see and get a feel for the types of names that you might see and when you would be using one account versus the other. The main two being the green and yellow accounts. We'll be using the green accounts as opposed to the yellow accounts if the forward contract was reversed. So notice we have two kind of speculations that we can make. We can speculate that the currency is going to get stronger or the currency is going to get weaker. So, and at this point, and then we would basically set up our forward exchange contract in separate ways. Now, obviously, that's if we use the forward exchange contract for speculative purposes only, as we're basically doing here. So, in other words, what we saw in the past typically is that we have the foreign currency receivable from the exchange broker. In other words, we expect to get receiving foreign currency. This would be the value that would change over time. And then we'd have the dollars payable, meaning the dollars that we put on the books would stay constant. So under the yellow accounts, which is what we have done in the past, we would have this item would be changing, fluctuating with the change in the currency because we're going to get paid in the foreign currency. And this one would not fluctuate because we're going to get because we will be paying in terms of dollars. And then this time, what we're going to do is we're going to say that we're going to have the dollars receivable, meaning we're going to get paid by the broker in dollars at the end of this contract 180 days later, and we're going to be paying in foreign currency. So we're going to have the foreign currency payable to the exchange broker in foreign currency. So in this case, this item is going to be the one that will fluctuate. The receivable, what we're going to get in dollars from the exchange broker, will remain the same. So you can see, if you focus then on the item that will fluctuate with the yellow accounts, the item that will fluctuate is the foreign currency receivable. When would you do that from a purely speculative position? You would basically say, well, I think the francs are going to get stronger compared to the dollar, because in that situation, you would then be getting paid in francs in the future that are going to be stronger than they were when you went into the contract, which would mean that you'd have a gain. You'd be getting stronger francs that are stronger at the end of the contract than they were at the beginning. So if you think the francs are going to get stronger, you would want to go into a forward contract where the foreign currency is the receivable and the payable you're going to be paying in dollars. If you think then conversely, of course, that the francs are going to get weaker, then you want the green items here. So we're going to say the foreign currency payable to the exchange broker will be paid then in the foreign currency. So now we're sitting in the green items, we're going to be paying the francs in foreign currency. Why would we do that? Because we're assuming that the francs are going to go down in value than where they are now. If they're going to go down in value, then we're going to be paying francs 180 days from now that are worth less than they were today. And that's if we think that's the case, then we want to do the green basically scenario, because that would result basically in a gain. We're paying with something that is less valuable than it was at the time that we took out the contract, and then we would be keeping the dollars steady, meaning the receivable in the dollars would basically be the same. So the dollars would be stronger in relation to the francs that we are paying, in that case, resulting in a favorable position. So that's going to be the scenario we have. So here we're going to put the dollars receivable from the exchange broker and then the foreign currency payable to the exchange broker, the green accounts, the dollars receivable then increasing on the debit side, and then we have the foreign currency payable increasing on the credit side. We're going to be calculating that by saying that it's going to be 5,000 francs. 5,000 francs that we're then going to be converting at this point using the forward exchange rate, just like we normally would with a forward contract. So we're speculating till the end date, to the end point, which is going to be 180 days from now, or on 41x2. So we're going to be taking then that 5,000 and multiplying it times the forward rate as of the 10-1, which is 0.74. So that's going to be 3,700. That's going to be the calculation. This 3,700 up top will be in dollars. We expect to receive dollars, so no change will happen on that until 180 days later. We don't have to change it for foreign currency or anything like that. This one down here, however, is going to be a payable that we will make in francs. Therefore, this one will change, and we'll have to change this because we're going to actually pay in francs, and we'll have to revalue it as time passes to see what the valuation of it will be. So then we're going to scroll on down, and we're going to say now it's the balance sheet date as of 12/31. We got the balance sheet date as of 12/31. We then are going to revalue the one side of this that we need to revalue. Remember, we don't need to revalue the dollars receivable. We need to revalue the foreign currency down here. So we're going to revalue now the payable. So to do that, let's go back up to where we prior were. This is where we left off. At the 3,700, we're now going to revalue that 3,700 for the current date because now we're saying it's 12/31. To do that, we're going to take the 5,000 francs that we're going to pay at the end of this thing. We're going to pay in francs, 5,000 francs, times the current forward rate, because we're going to pay it 90 days from this point in time. So we're going to say times 0.78. We're using that kind of speculative rate into the future. That means it's going to be 3,900. If I take that minus the 3,700, we then have a $200 difference. That difference then being a loss. Why is it a loss? Because last time when we took out the contract, we said that 1 franc was worth $0.74. This time, 1 franc is worth $0.78. The franc has now gotten stronger, and we're going to be paying in francs, something that now has a greater value than it had when we took out the contract. And so that's a loss, right? It's opposite to what we kind of were expecting to happen if this was a speculation and if we wanted to benefit, obviously, from the speculation, right? So it started off going the wrong way here. So if we go down, we're going to say the foreign currency transaction loss will be the 200, and then the foreign currency payable to the exchange broker credit for the 200. So we got the loss down here on the income statement. So now we have our loss down here. And then we have the foreign currency loss is going to be included in the foreign currency payable. Now that at 3,900, once again, that calculated for the 5,000 francs we will be paying times the current forward exchange rate 0.78, which is this item here, giving us that 3,900. Next, we're going to say on 41x2, this is when the thing expires, right? So now we're in the following year, and now the forward contract is over at this point in time. So first, before we get into any details, note that it's the following year, so we're taking the ending balances from the prior year, We're including we're going to start with those at the beginning balances. We took the full equity section, which is the 100 and the 200, netted that out into simply the equity section here. So we have a post-closing trial balance or beginning trial balance for year 2, a trial balance with no temporary or income accounts in it as we move forward. Now we're going to say it's the end of this forward contract. It's 41x2 at this point. So this thing is going to close up. Before we kind of close it up, we first want to revalue the item that needs to be revalued. Once again, the dollars receivable does not need to be revalued because it's in dollars. We're just going to get dollars. No, not a thing there. But down here, this is the one that we need to change because we're valuing this thing in dollars. And you can see the difference right now. That's why we had a loss before, because we're going to get the dollars up here in dollars, which is 3,700. And down here, we're going to pay francs, which are worth 3,900. So we're paying more in terms of dollar valuation than up here. That's why we had a loss. So now let's revalue it again and see if we're getting into a better situation. We're going to revalue it as of 4/1. So we're going to take then our 5,000 francs that we're going to be paying at the end of this thing, and now we're going to multiply it times the spot rate. Why the spot rate? Same reason for the spot rate, because this forward contract was forward towards a certain point in time, the end of the contract, which was 180 days from the start of the contract. Then we had 90 days from the balance sheet date. Now it is that point in time. It is today. There is no looking forward. This is it. We're in that moment. So now we're going to take that 5,000 times the current rate, which is the spot rate, 5,000 times the 0.77. That's going to give us that 3850. So the 3850, if I take that minus what was in there before, 3900, we have a $50 difference. That difference is going to be a gain. We're going to have a gain now. So why do we have a gain? Why does this result in a gain? Because last time we had 1 franc was worth $0.78. Now we're saying the 1 franc is worth $0.77. The franc has gotten weaker. That's kind of what we predicted to happen because we want the gain to happen. So the franc has gotten weaker and we're going to be paying francs. So we're going to be paying something that is now weaker than it was the last time we measured it. So therefore, we're going to say that now we have a gain of the 50. It doesn't negate the loss that we had last time because we had a loss last time of the 200. So, but now we have, at least it nets it out a little bit, right? So we got a gain of the 50. The other side is going to go to the foreign currency that we're going to pay in francs. So now we have the foreign currency we're going to pay at that 3,850. And then the other side is going to be included in the gain, which is included in the income of the current time period. So then that 3,850, just remember, is the 5,000 francs times the 0.77. And then obviously you can calculate this $50 to that change. It can be useful just to note that you could take the prior rate you were using, which was 0.78, the forward exchange rate, or minus the current rate, 0.77, times the 5,000 francs, and that'll give you the $50 as well. Okay, so then the next thing we're going to do is we're going to pay off. Let's keep it up here for just a second. We need to pay off that 3,850. We've got to pay off that amount, but we're going to pay it in francs. So it's actually 5,000 francs that we owe that we valued at $3,850. And note, we still have a loss too, by the way, between this, because now it's the end of the contract, and you can see we have the receivable in dollars. We're going to get $3,700. We're going to pay francs, 5,000 francs, but now the francs are worth 3,900. So between the 2-year period, 3,900 minus the 3,700, or actually, let's value it over here. We have the 3,850, 3,850 minus the 3,700. Now we have a 150 still of a loss, right? Because we had a $200 loss before, and now we have the $50 gain netting out to a $150 loss. And you can see that by the difference between the valuation of the receivable, which is in dollars, and the valuation of the payable, which we're going to pay in 5,000 francs, but are valued in US dollars at 3,850. So the payable is higher than the receivable. That's not good, right? So then we're going to pay off this payable of the 3,850, but we're not going to pay it with cash. We're going to pay it with francs, meaning we're going to pay 5,000 francs, which we currently valued at the $3,850. But we don't have any francs. We only have dollars. So we're going to spend some of our dollars and buy some francs, which isn't a problem because we already know what the exchange rate is at this point. It's the spot rate of 0.77. So we're going to take then, we need 5,000 francs, and we're going to spend dollars on that, which is times 0.77 for the exchange rate, which is $3,850 that we're going to spend to get 5,000 francs, which are valued, of course, at $3,850. So that's going to be our transaction here. We're going to then say that we're spending the $3,850 and we're getting the francs now. So when we record that out, we get the francs up here. We've got the francs recorded. They're just another asset. They're just like any other asset at this point in time. It could be stocks or something else like that, right? We're just saying we have 5,000 francs, but we have to value them in terms of US dollars. Even though it's another currency, we're just valuing them as US dollars, which is 3,850 US dollars. So now we have 5,000 francs that we're representing on our books with the current equivalent in dollars of 3,850. And we have, of course, the payable on the books now currently valued, which means we owe 5,000 francs that we're going to pay in francs, but which currently valued in US dollars at 3,850. So now we can pay off the payable with the francs that we just have purchased with our money. So now we're going to do that. We're going to say, all right, so now we're just going to pay off the payable, 3,850 debit, and we're going to pay off we're going to do so with the francs. So just remember that when we do this, we're actually spending francs, 5,000 francs, which are valued at 3,850 for the currency and then 3,850 for the payable. And that should then take down these amounts. So it should take them down to zero. So now the foreign currency units in francs is down to zero. We don't have any francs anymore. And now the payable has now gone down to zero as well. So the payable is now at zero as well. So then then we're going to need to get the money, the receivable that we got, which is simply going to be in cash. So if I scroll back up top, notice that we had this receivable, the other side of the contract, in cash, and they agreed just to give us the money for that one, right? So the receivable is what it is. That's been on the books, hasn't changed since the beginning when we first put it on the books. And you'll recall that was for when we entered into this exchange contract on 10/1, it was the 5,000 francs times the current forward exchange rate, which is 0.74. So that we put it on the books at the 3,700, hasn't changed. In 180 days, they're going to pay us, the broker's going to pay us 3,700. So from an accounting standpoint, that side's going to be nice and easy. We don't have to do anything to it. We haven't had to adjust it. And now we're just going to say that as of the end of the time period, they're going to pay us those dollars, the exchange broker will. Therefore, we're going to get cash, 3,700, and the dollars receivable will then go down. So the cash is now included up top, and then the dollars receivable has gone down here, down to zero. So at the end of the day here's where our cash was. Now, all we've recorded is this forward exchange contract over the 2-year time period. So you can see that that's the only effect on cash, and the cash went down over this time period, right? So our US dollars went down due to this. So the speculation wasn't good, right? Because we decreased on the speculation. We have the foreign currency units here that we received, or we had to buy foreign currency units with cash in order to pay off the forward contract, because we said in the forward contract that we were going to pay in foreign currency units in the francs. Then we have the dollars receivable from the exchange broker, which we received from the exchange broker at the end of the contract. Then we have the foreign currency payable to the exchange broker, which of course we paid off at the end of the contract. We had to basically get the currency in order to do so by spending cash to get the currency. And then we have on the income statement what happened this year in year 2, which was a $50 gain. So we had a $50 gain in year 2. However, in year 1, we had a loss. And you can see that loss because it was included in the equity section here, which was, we had a $200 loss because it was at $100,000. Now it's at $99,800. So even though we had a gain in year 2, the net effect over the time span was a loss. So just to recap that on the speculation, then when would you speculate? You can make, if you're using a forward contract for speculation, then there's 2 ways you could set it up, right? And you're setting it up to see whether or not, because you're speculating that the foreign currency is going to go up or down, and obviously you want to win You want to come out ahead. You want to have a gain. You want to have more money at the end of the day. Not this way. We got a loss here, right? So what would you do? The two ways you could set up the forward contract, these two ways, and you're speculating whether the currency is getting weaker or stronger with the two yellow accounts here or the two green accounts. So let's just review that one more time here. With the yellow accounts, you've got the foreign currency receivable from the exchange broker is going to be in foreign currency. So you're going to get the receivable side of things in the foreign currency, and the payable side of things, because you're setting up an equal receivable and payable based on the current rate, the forward exchange rate that you currently have, the payable is going to be in dollars. So in this scenario with the yellow accounts, the thing that will vary will be the receivable, because it will be paid to you in foreign currency, whereas the payable side of things will remain the same. On the green, if we use the two green accounts, we're going to say then we're going to get the dollars receivable from the exchange broker in dollars. That's the thing that will not change. The thing that will change is we're going to pay the foreign currency payable to the exchange broker in francs. Therefore, the foreign currency item that will change, that we'll need to account the change for, will be the payable and not the receivable. So when would you record one or the other? Well, if you're doing the yellow accounts up here, then you're saying that you're going to get paid the receivable in foreign currency in the future. If you're going to get a receivable in something other than cash, you're hoping that the value of it will go up in relation to cash. So you're betting then that, or you're speculating that the foreign currency, the francs in this case, are going to get stronger. If you think the francs are going to get stronger, then you want to be paid in francs in the end of this thing, and then you'll set up that you're gonna pay in cash, right? Because the francs are going to get stronger relative to the cash, the money, the dollars, and therefore you'll come out ahead. If on the other hand you do the green accounts, then you're going to have the foreign currency payable to the exchange broker in francs. So now you're going to have the foreign currency payable to the exchange broker in francs, the payable. You're going to actually pay this thing at the end of the contract in foreign currency in francs. And now if you're going to pay in francs, then you're hoping that the thing that you're paying with has gone down in value with relation to dollars. You want to be paying in things that are worth less, because you're going to be receiving dollars. So you'd like the dollars to be higher than the francs that you're going to be paying. So in this case, if you're speculating in this way, you would be speculating then that the francs are going to go down in value, have a decrease in the value. Now, also just note that we've been focusing more on the yellow accounts when we use it as something like a hedge, a forward exchange contract as something like a hedge or something like that, because often we're using it to hedge against a purchase that was made, a purchase that we're going to make in foreign currency. So in other words, if we made a purchase on account in foreign currency, as we've seen as our practice problems would be, we'd have a payable then on the account in foreign currency. And if we have a payable on the account in foreign currency, if we want to like hedge against or have some kind of counterbalance to the foreign currency effect that could happen with regards to that payable, then we would typically want to set it up as the yellow accounts, right, in order to do this. And that will also allow us to have the francs or the foreign currency that we will need at the end of this thing in order to pay off the payable. So if we had purchased something, as we've seen in prior problems, such as inventory or something like that, or equipment, and we're going to pay in foreign currency, and we have a payable in foreign currency, then we might want to set up the forward exchange to have the foreign currency receivable from the exchange broker in the foreign currency. Therefore, it provides us with the money in foreign currency, the foreign currency we will need to pay off the payable, and it'll act as a counterbalance, because the receivable will be, as the value of the currency changes, they'll be valued in opposite directions, right? As if the currency gets stronger and we have a receivable, that will result in a gain for the receivable. It'll result in a loss for the payable. If the currency gets weaker, and on the receivable side, then if the foreign currency gets weaker, we're going to have a loss on the receivable, but we should have a gain on the payable side. So that's kind of why we've been focusing in a lot of times with the yellow accounts, if we're the yellow side of things, if we're focusing in on using this thing as some kind of hedge or counterbalance to something that we purchased on account.